Okay, when you look at two successive balance sheets in the cash flow statement, and you've got some income statement information as well, what you effectively have is the accounting equation that shows you all the changes that have happened during the year. So changes on the balance sheet are up here in these two columns, changes on the income statement are down here. And hopefully they actually add up to the profit. Well, with dividends, they should end up explaining to you what the total change in retained earnings was. So what you have here, this change between retained earnings, is essentially explained down here. So we don't need to look at that number directly. Okay, we know that the accounting equation balances, and we're trying to explain what has happened to cash. Now, if we're trying to explain what's happened to cash, then it must be the case that whatever change happened in cash, whether that's a total debit or a credit, the sum of those changes must be the same everywhere else. Okay, so what that basically means is that if you take a really naive approach to understanding cash, you could say, well, hang on, look, accounts receivables gone up, and so that probably means somebody gave us, we gave somebody money. Well, which of course is not true, but you could sort of think of that. If somebody owes us more money, we must have given them some money. So you can think of it that as an outflow. And, in a sense it probably is, because you think about all the sales revenue we've made for the year, right? And you know that some of that sales revenue basically has come in as cash. The rest has gone into accounts receivable. So what you can do is you can think, look, all these sales came in as cash, but some went out because we gave it to people. In other words, it didn't come in as cash, they continued to owe it to us. So what you can do is go through each of these items and link them with something else. So accounts receivable links with sales, for example. Inventory doesn't link directly with anything, but if you think about inventory and you link it with cost of goods sold, then you should be able to work out how much inventory was purchased. And then if you link that information with accounts payable, you can work out how much we must have paid our suppliers. So by putting these things together and ticking them off as we go, we can use that information to work out what the cash flow must have been. Now, obviously, sometimes you're going to have some physical assets changing. Like, for example, here you'll see that property, plant and equipment has gone up. Now, you need to think what those changes possibly are. I mean, if you don't know anything else, you would probably think, okay, we've bought some property, plant and equipment, so therefore that must be a cash outflow. However, it's not as simple as that. In this case, we've also sold some. So there must have been a cash flow from selling some and another cash flow from buying some, so we need to untangle those to work out what the investing cash flows were. Actually, to be absolutely honest, there is another possible change in property, plant and equipment. It could have been revalued. So if I see property, plant and equipment going up, one of the first things I'd want to look at is down here in owner's equity to see whether a revaluation surplus has gone up. Now, if you've got multiple assets, then you'd need to look down in the additional information to work out, which assets were revalued, which ones weren't. You might also have some non-cash transactions. For example, somebody might have given you some property, plant and equipment, but in exchange, you've given them some shares, so share capital's gone up. So you need to look for those sort of changes. Once you have excluded any changes which were obviously non-cash, whatever's left must be a cash change. So property, plant and equipment, we can put a little star there, a little asterisk, sort of. I'm bad at drawing, because we're going to pick that information up from here. Now, what about accumulated depreciation? Depreciation doesn't change because of cash. So I don't want to say we're going to ignore that. What we would really do with that is we would tick it off against the depreciation that happened for the year. Oh, and by the way, some of that change in accumulated depreciation changed because some of the accumulated depreciation went out in relation to the asset that was sold. So if you have a look down here, we've really got the income statement. We haven't told you what the depreciation is for the year, but if you've got net profit after tax, and you've got all the other expenses, well, most other expenses, you can probably work out what the missing depreciation was. And that, together with the accumulated depreciation relating to the sold asset, would help you explain the accumulated depreciation. So you can basically tick that off there and tick it off down here against the depreciation expense. Right, so what do we have so far? We've got accounts receivable together with sales is going to tell us something. We've got inventory together with cost of goods sold, and accounts payable is going to tell us what's happening with suppliers. Property, plant, and accumulated depreciation will be explained partly by this sale and partly by the depreciation, which we can work out